Okay, so good morning, everyone. Thank you all for joining us and welcome to this presentation titled Houston Commercial Real Estate State of the Markets. I'm Rod Alva, President of the Real Estate Committee at the Argentina-Texas Chamber of Commerce. Also joining us from the Austin chapter is Daniela Roca, also a director at our Chamber of Commerce and active member of the Real Estate Committee.
Good morning, everybody.
Good morning, Danny. How are you? So before we start, a brief introduction on the Chamber of Commerce. The Chamber is a non-for-profit organization that collaborates with local governments and private enterprises with a mission of fostering commercial relationships and knowledge sharing between the state of Texas and Argentina. We have 5 chapters: Houston, Dallas, Austin, Buenos Aires, and Patagonia, and 5 industry-specific committees: energy, technology, healthcare, food and beverage, and real estate. To become a member or a sponsor, you can visit argentinatexas.org. So with that introduction out of the way, we can now focus on today's agenda. Today, we will cover a general overview of the Houston economy and the commercial real estate trends of 4 major asset classes. We'll cover multifamily, office, industrial, and retail. Costa will touch on market fundamentals, supply and demand, vacancies and rates, leasing activity, transaction volumes, cap rates or asset prices, and debt markets. Where are we at and where are we heading? Time permitting, at the end, we will share a couple of questions with the speaker, and that will conclude our presentation. So to deliver this presentation, we have invited a remarkable speaker from CoStar Group. For those who are not familiar with CoStar Group, CoStar is the undisputed leader in market intelligence for commercial real estate in the United States. Joining us today, we have Itziar Aguirre. Itziar serves as Senior Director of Market Analytics for CoStar Group in the Houston office. She has more than a decade of experience in commercial real estate and holds a Master's of Science degree from the London School of Economics. Good morning and welcome, Itziar.
Thank you, Rod. Thank you for having me. Well, without further ado, I can just take it away. I'm going to take off my camera while I speak because it's been flickering and I don't want it to be a distraction. I'll put it back on for questions. And I will kick it off. Okay, so before we get started, kind of just reiterating what Rod mentioned, I'm going to cover a little bit on the economy in Houston and local demographics, what's going on in that sense, population, job growth. And then I'm going to talk about multifamily, office, industrial, retail, and capital markets. All right. So Houston has consistently held the #2 spot for most population growth over the past 4 consecutive years, due to things like affordability compared to other large metros and, of course, employment opportunities. Last year, if you notice, we added almost 200,000 new residents. And if you look back from 2020, every year we've continued to add more. So not only have we held that 2nd spot, but we've also grown our number in terms of new residents added. So if we look at domestically within the US, where are a lot of these folks coming from? Well, significantly, California is our top source. This is just undisputed. When netting out move-outs and move-ins by state, California ranked the highest with more than 55,000 folks. This figure roughly equates to the next top 5 states combined. So Illinois, Louisiana, Maryland, New York, Florida combined added about the same as those folks from California. Now, this next chart shows the top 10 fastest growing counties in the US. The 2 in green are Houston specific. Notice how 4 of these 10 are in Texas. It's worth mentioning that in Houston, population growth in Harris County is due to international migration and then births exceeding deaths. However, in Montgomery County, this is typically different. It's largely domestic. So from both out of state and also local Houstonians moving to more larger, more affordable housing, good public schools, especially near the, Cinco Ranch, Katy, the Woodlands, which is also becoming a strong employment node of its own. So Cinco Ranch is in Fort Bend County, and that actually didn't make the cut, but that typically ranks highly as well in terms of top counties for population growth.
Mhm.
So now let's switch over to employment for a little bit. If we look at the most number of new jobs added in the country by Metro since February 2020, so right before the coronavirus pandemic, Houston ranks third, behind only DFW and New York for most new jobs added since then. We've expanded our pre-pandemic employment base by almost 300,000 jobs as our economy continues to grow and diversify. So by a percent change, it's about 7.5% larger than it was February 2020, so 5 years ago. We're still very much an oil town, but industries like healthcare, aerospace, and biochemical research are definitely gaining traction. However, job growth, like national trends, is slowing. So after posting 3 consecutive years of 100,000 plus new jobs, 2024 slowed down to below 50,000. That actually puts us below our 20-year average trend of 65,000, that red dotted line. Through April, we are down about 9,000 jobs year to date, but I'm actually not really concerned, as this is largely due to losses in January coming out of the holidays. Since then, we have added jobs each month. And I will say before diving into multifamily, one of the reasons I think that 2024 was lower was because 2021, 2022 were really extraordinary years coming out of the pandemic. We were recovering a lot of the jobs losses, and now there's just kind of a right sizing going on where we should be returning to historical trends. So I'm Houston typically, there's all this chatter of, are we headed towards a recession? Are we not? Houston typically is the last one in and the first one out, and so far I'm not really concerned about a recession. We'll talk more about that later. So now let's dive into multifamily. So if you remember anything from what I'm going to say today, trying to remember these 3 important kind of takeaways for multifamily. So 1, demand has returned. It returned last year and it's continued this year really strong, and it's above pre-pandemic trends. 2, the recent supply wave has kept rents flat. We have been hit with a lot of supply over the last couple of years, and that has affected rent growth. And 3, there's been a big drop off in multifamily construction starts over the last 2 years, and this is paving the way for a pretty tight market by next year. Okay, so before I talk about this graph, I'm going to break it down. Blue bars is new supply. Orange bars is net demand, so absorption, difference between move-ins and move-outs. And the green line is the vacancy. So there's no sugarcoating it. Right now, the vacancy rate in Houston is high. It's at about 11.3%, which is basically at 20-year highs. For context, the 10-year average is around 10%. So how did we get here? Well, we've had a pretty few volatile last few years. So in 2021, we had a record high of pent-up housing demand coming out of the pandemic. Nearly 40,000 units were absorbed, the strongest on any year on record. 2022, the lowest on any year on record. Demand fell to a record low as inflation hit us really, really hard in Houston. And then most recently, 2023 and 2024 combined, we had roughly 50,000 units delivered. That said, demand remains really, really strong. So last year was among the strongest on record, similar to national trends. We absorbed around 18,000 units, which is nearly double the 5-year pre-pandemic average. So between 2015 and 2019, roughly 11,000 units per year were absorbed. So we're well above our pre-pandemic trend. We're seeing that figure will likely come down from last year, but it's still anticipated to be really high. Why is it going to come down? Largely as a result of new supply coming down as well. So new supply tends to drive a lot of the new absorption. As supply comes down, absorption is coming down as well. So this chart breaks down units under construction to the left by price point, and then construction starts to the right. Like national trends, groundbreakings have really slowed down a lot over the last couple of years due to several factors, including high borrowing costs, high construction costs, slowing rent growth, and tighter lending standards. All of these have just really made deals difficult to pencil. Right now, our under construction pipeline is at 13-year lows. The takeaway from the chart to the left is basically, historically, developers have primarily built 4- and 5-star luxury properties. And while this definitely continues, notice how the red bar, the 3-star, kind of class B, if you will, those are gaining traction. Developers are starting to build more. And so by this, I don't mean 1970s vintage properties. By this, I mean primarily suburban new communities with a lot less bells and whistles in terms of amenities. So developers have started many to scale back on fancy amenities and therefore make these communities more affordable to your average Joe. So we're starting to see a lot of new communities just with less amenities that are not necessary, often in the suburbs. To the right, we've got construction starts. Last year, total groundbreakings were less than 9,000 units, which was 54% down from 2023 year over year. And it was about 1/3 of the total tally of 2022, when about 28,000 units broke ground. This year, we are very much still disciplined, and groundbreakings remain near 10-year lows. Now this chart looks at Houston's construction pipeline compared to other markets. So this chart looks at the top markets with most units underway. The takeaway here is that right now Houston is at number 15 in the country in terms of the market with most units underway. However, those top percentage figures on top of the markets, those are the percentage of inventory underway. Houston is at 1.6%. For context, the national average is about 3.3%. So we are very, very disciplined. Another takeaway that I think is important is about a year ago, or maybe even less, 10 months ago, this chart was filled with double-digit figures on the top. So a lot of markets were building in the double digits in terms of expanding their inventory. Right now, just one, Miami. Everything else are most of these markets we've seen the pipeline thin significantly, and basically most of these markets, Nashville is a little bit high as well, 8%. But for the most part, and Charlotte, 9%. But for the most part, notice how most of these are, in the 2-3%. So pretty disciplined pipelines. And this is just a result of not just Houston, but nationally, we're seeing groundbreakings across markets really slow down. So where are developers building in Houston? Well, primarily they are building in the urban core and then also fast-growing suburbs. So especially to the north and west of the city of Houston. So think Magnolia, well above the Woodlands, Conroe, that area in the north. And then think, of course, to the west, Cinco Ranch, Katy. One thing I also, one area I want to call out is Manville. Manville is right below Pearland, and that area is also starting to get a lot of developer attention. Um, it's seeing really strong population growth. Pearland started off as a bedroom community several years, 2 decades ago, but it has slowly turned into kind of an economic hub of its own. It's become more affluent, more expensive, and so people are also moving further south in that, I don't know if you see it on the map, Alvin. So it's right next to Alvin, Manville. So both of those cities are starting to get a lot of developer attention following strong rooftop growth. In the urban core, we're seeing still some high rises underway. That's why we've got that big dot geographically. And it's primarily high rises and mid rises, as there really just isn't a lot of buildable land left in the urban core. A lot of mixed use projects. And that's basically the type of construction we're seeing in terms of multifamily. So this chart, if we talk now about rent growth for a little bit, it includes the top 25 markets with most inventory. Houston is holding up pretty well compared to other fast-growing Sunbelt markets. So notice Charlotte, DFW, Orlando. Look at Austin. It's more than -4% year-over-year rent growth. Houston is kind of having its moment. Houston has not really historically been a leader in rent growth, if you will. We've typically averaged around 2% over the last decade or so per year. Part of it is because we've got little if no zoning laws, so it's really easy to build here for the most part. But that being said, since 2023, since the second half of 2023, if you compare Houston to Dallas, San Antonio, and Austin, those three markets have been firmly in the red in terms of negative rent growth, while Houston has not. Houston, through all of this supply wave, inflation, all of this that's been going on, Houston has managed to keep rent growth slightly positive. One more thing I'll call out is that, those markets to the left, for the most part, it really is a supply demand story. So for the most part, they're not seeing that much new supply, and hence rent growth is stronger, though there are exceptions. So New York, for example, and Miami, those are exceptions. They're seeing a lot of supply growth, but they're still able to push rents quite a bit. To the right, all of these guys in the red, all of these markets, they were some of the best performing markets a few years ago, well in the double-digit rent growth, and now they're some of the worst. Just as we're working through, they're working through a significant supply wave in all of these markets. In Houston, so where is Houston and seeing the best rent growth? Well, it's again a supply demand story. So to the left, we've got affordable, a lot of workforce housing heavy, renters by necessity heavy areas like South Central Houston, Alief, Brook Hollow, Inwood. All of these areas are among the cheapest in Houston. Not a lot of new supply. They're doing best. Conversely, to the right, some of the markets that are performing the worst are expensive and supply heavy submarkets. So outlying Montgomery County, Pearland Heights, those are areas that have recently been slammed with new supply, and add to that already high rents, and it's done a number on rent growth. Also, the percentage of inventory underway is also high, so that's why these submarkets are slightly in the red. So now looking at our crystal ball, CoStar, notice how vacancies have started to come down. They're still high, they're still near 20-year highs, but they are starting to come down, and we are predicting further downward compression, just largely as new supply really pulls back sharply and demand stays healthy. So the blue bar for 2025, we are expecting about 9,000 units for this year. That puts us at a 7-year low in terms of new supply. So that should give us some time to absorb the recent supply wave I mentioned, the 50,000 units that were delivered over the last 2 years. Just 2 more thoughts before we move on for multifamily. I do want to mention a little bit eviction filings. So this chart shows us monthly evictions filed in Harris County over the last 20 years. Evictions fell to all-time lows in 2021 due to the eviction moratorium, but once that was lifted, they have soared. And if you notice, they remain quite elevated. That 2015, 2019 red line, that's the monthly average. It's around it's around 5,000 per month. Right now, during the first 3 months of the year, filings have averaged 6,300 per month so far this year. That's about 35% above pre-pandemic norms. So this does remain an issue. This remains a huge headache for a lot of property managers that I speak with, and this is definitely something to keep an eye out for. And then very last slide on multifamily, I did want to talk about kind of future predictions for rent growth. The blue bars are the 1 and 2 star properties. So think Class C, Class D properties. The 3-star, think Class B, those red bars, and then the 4 and 5 star are the luxury segment, the yellow bars. So for the most part, the more affordable the property, the stronger the rent growth, largely just because there has not really been a lot of supply-based competition. 2021 was truly just anomaly year, and 4 and 5 star led rent growth. That really was a blip, and right now things are kind of returning to normal. But one thing that I do want to call out is the spread between the more affordable properties, the rent growth spread, and the luxury properties. That spread is thinning quite rapidly, and we are predicting it to be practically the same, all types of price points, properties to perform similarly. Why? A pullback in new supply in these luxury properties paired with ongoing strong demand. So that's something to really think about going forward. We're anticipating rent growth to perform very, very similarly in the next couple of years across all different types of these multifamily properties. And this is just one final slide. Right now, it looks like you are walking, and rent growth next year is really anticipated to rebound and be around 2.5% by middle of next year, which puts us slightly above our 10-year average of 2.2%. All right, so now let's talk about office for a little bit. Again, 3 takeaways I want you to remember if you don't remember anything else. Number 1, 2025 is bringing more clarity in terms of expired leases. So 75% of pre-COVID office leases have already expired. Number 2, tenants signing smaller leases. This is really what's driving the market right now is tenants signing smaller leases, often in the newest and best buildings. Number 3, like multifamily, new office construction has all but stopped, even more so actually than multifamily, which could lead to future lower vacancies. Now this chart breaks down the square feet leased as of April 2020. So through this first quarter, 75% of these leases have expired. And then looking ahead, around 18% are expiring before 2030, and 8% are expiring in 2030 or later. So what does this tell us in English? Basically, most most big office, the right sizing, the footprint sizing, most of it has been decided by now. So we saw a lot of, in 2023 and 2024, we saw a lot of really large leases being signed during those 2 years. And we saw just a lot of movement, especially from large occupiers, moving into newer, newer office space, even though often it was actually a reduction of their former space. So that is largely in the past. So while the leasing market is active, I keep hearing from local brokers that leases are getting smaller. And our data confirms this. While down from 2023 all-time highs, 2024 was actually the second highest on record in terms of most number of deals signed. Meanwhile, the average lease size fell to a record low of around 3,200 square feet. So I looked and it's ticked up recently this year to around 3,700 square feet, but it still remains below pre-pandemic norms. Now, if we look at leasing volume, Houston office leasing brokers do note, like I said, that the market is active. And again, our data CoStar reflects this. In the 12-month period ending in the first quarter of 2025, about 16 million square feet was leased, which is roughly 10% above the 2015-2019 annual average of 14.6 million square feet. So while the trend of smaller office footprint continues, the number of leases, like we just talked about, remains really, really high. It remains well above pre-pandemic trends. So where is demand strongest? In Houston, it's mainly in medical occupied buildings. Nationally, demand is strongest in owner occupied buildings. So in Houston, demographics, including aging population and just population growth, are supporting demand in medical buildings, often in fast-growing suburbs. Now, if we look at buildings by age, this chart, it's based on the age of the building at each point in time. Generally, newer buildings have seen consistent demand, so mostly built 10 years ago or less. But more recently, older ones have started recovering because, it probably has something to do just with lack of availability in newer ones, since the construction pipeline has shrunk dramatically. Also, something worth noting is concessions and free rent have been very, very generous among older buildings. And this kind of confirms this, slicing the data in a different way. If we look at vacancies across submarkets in the U.S. In Houston, by 2015, in buildings built by 2015 and later, and built before 2015, notice how for the most part vacancies are much higher in older buildings. So the problem with Houston is we have a lot of old buildings. Roughly half of our office stock was built in the 1970s and 1980s. And when we talk about new supply in recent years, a lot of it has actually been medical space in fast-growing suburbs. It hasn't been, we haven't seen a lot of new office towers pop up in the urban core. There have been some, but really not a lot. So where is demand geographically? Well, it's strongest in the suburbs. As Houston's population continues to move north and west, companies are paying attention, and some of them are opting to move closer to where their employees live. So one area that has, it's been really, really strong lately is the energy corridor. Leasing activity has been really active, and it's not surprising. Its location is really a short commute to many of Houston's fast-growing western suburbs. Now, if we talk about construction, you're going to see a similar theme in terms of construction throughout this presentation. Construction pipeline in Houston remains near all-time lows. Like we talked about, this is a direct result of high borrowing costs, high construction costs, tighter lending standards, flat rent growth. All of this has contributed to just a really sharp pullback. It's been disciplined, the construction in Houston's office market. It's really been disciplined since, I would say, the oil bust, but it's really 2015, 2016. But it's been slowing down even more in recent quarters. About 80% of what is underway is pre-leased, so that's going to really minimize the impact of new supply. Like we talked about earlier, a lot of the space that's underway is in fast-growing north and western suburbs. I've been told repeatedly by my local contacts that building a spec office building right now to obtain financing is practically impossible. There have been exceptions. So recent projects like Midway City Center 6 office and Moody Rambin's Town Center 2 both are within or near city center. And they've actually leased very quickly as they've delivered, and it really just highlights and underscores the strong demand for quality office space among walkable, high-density settings. Those buildings are performing very well. So what does this mean going forward? The market is going to continue to face a shortage of first-generation available space. So we've got, I've got some brokers telling me, well, tenants will start backfilling second and third generation space in the coming months. That's one way to look at it. Another way is maybe other tenants just stay put and renew their leases. So I think it could play out either way. Some of them moving into kind of older buildings if they're renovated enough, whereas others will probably just stay put. Now let's talk about an important office demand driver, job growth. So like national trends, office using job growth is slowing in Houston. This is due to a combination of national economic factors. So inflation and interest rates are making some businesses cautious about hiring new office workers. But then also there's really, I think, a bit of a market correction following a period of rapid growth that we saw coming out of the pandemic, 21, 22, a little bit in 2023. Right now we are around 1%. And if we continue to slow down in terms of year-over-year office using job growth, we're going to be below the 2015-2019 pace. So looking ahead, Oxford Economics predicts that office using job growth is going to continue to slow down over the next 5 years throughout the US, though more dramatically in some markets than others. As baby boomers retire and fewer workers enter the labor force, this is definitely going to be a drag. So Austin, for example, it's set to see the sharpest slowdown, going from 35% cumulatively growth from 2019 to 24 to just 10% cumulatively from 2024 to 2029. Houston, for example, it's anticipated to go from 15% to just 5%, still slightly above the national pace. But like I mentioned earlier, healthcare is a bright spot. Ambulatory healthcare, so not ambulance people, but rather think hospital outpatient departments, urgent care clinics, dialysis places, things like that. Job growth is now at around 4% year over year, aided by both an aging population as well as strong population growth. Healthcare is anticipated to remain a bright spot in Houston and continue to drive a lot of office using demand. Now, looking at our crystal ball, like we talked about, office using job growth is slowing. And so realistically, demand conditions are not expected to change meaningfully over the next year or two. Limited new supply, though, should help keep vacancies stable and maybe even compress should demand pick up. Local brokers tell me that boosting office attendance is at the forefront of a lot of conversations with their clients. So this could end up boosting demand. As the national economy slows down and growth remains stronger in Texas, it's very possible that new firms could continue to move here from out of state because they see growth opportunities. So what could go wrong with our forecast? Well, higher for longer interest rates that keep businesses cautious from hiring more workers, and more pronounced slowing of office using job growth. I added the red dotted line, our moderate downside. We've got several different types of forecasts, and the moderate downside is if we enter a recession. And in this case, CoStar is predicting office vacancies to hit almost 22% by the middle of next year. If we don't have a recession, they're still going to remain elevated, but at least they're going to be trending down slowly but surely. All right. So wrapping up office, let's move on to industrial. And again, I wanted to talk about just some 3 takeaways if you don't remember anything else. 1, it's one of the few large markets where demand remains above pre-pandemic trends. This is really noteworthy because that's definitely not the case across most markets. 2, the softer housing market is definitely affecting Houston. It's reducing bulk space demand. So think, for example, large furniture stores that were opening up a few years ago, those have stopped. But we've got other demand drivers that remain in place, and those are helping kind of balance out this negativity. And 3, the supply wave is nearly over, and again, we talked about this theme of pullback in constructions. It's also happening in industrial, and the supply pipeline is thinning. So let's talk about mortgage rates. Interest rates remain near 15-year highs, around 7%. Over 70% of outstanding mortgage loans have sub 5% interest rates. Over 70%, 70. If homes aren't selling, this affects industrial tenants tied to the housing industry. But we've got the port. It remains busier than ever, despite all of this uncertainty with tariffs. The fact is it's a major gateway for international trade, and container volumes were at a record high last year. And this year, that strong momentum so far, knock on wood, is continuing. For April, container flows were up 20% year over year. Year to date, container volumes are up 4% year over year. So if we talk about demand for a little bit, like I mentioned, contrary to the national trend where absorption levels right now are at 12, 13-year lows, we are still punching above our weight. While down from the post-pandemic boom, so 2021, 2022, absorption rates have remained much stronger than most major US markets. Right now, annual net absorption for last year was about 50% above the 2017-2019 annual average. Meanwhile, construction starts have pulled back sharply. They're at last year they were 61% below the all-time high of 2022, and less groundbreakings means less projects underway in the next few quarters, which means an ongoing thinning construction pipeline. So as a result, new supply is anticipated to continue slowing down. Last year already it was down 45%. And notice how that supply demand mismatch from 2023, which was a record year for new supply, has largely reversed. Right now, demand is actually, for last year, demand slightly exceeded supply. And now looking ahead, we have seen we have seen vacancies tick up a little bit in the recent months, and this is because while groundbreakings in general have slowed, a lot of these large speculative projects that are continuing to deliver, so these 250,000 and larger warehouses, distribution facilities, they are taking longer to lease. And we'll talk about that a little bit further. But all in all, it's a really good story for Houston. The industrial market is in great shape. We are anticipating vacancies to remain in that 6% range. Right now, our vacancy rate is at 6.8. For context, our 10-year average is 6%. So what could go wrong with our forecast? Well, tariffs. This really should have, depending on how tariffs play out, it could have a significant impact on manufacturers, especially those that lack the flexibility and capital to rapidly find alternative suppliers. It will definitely be impacting leasing decisions, so vacancies could stay higher for longer. So where is the current pipeline? Where is construction happening? Right now, we've got about 18 million square feet underway. Around 85% is available for lease. And we are seeing most of the construction near affordable, available land, especially around Beltway 8 and the Grand Parkway. So on the right-hand side, the Port of Houston remains a target, and areas like Baytown and Mont Belvieu have exploded lately. So combined, total industrial inventory in these two cities has more than doubled since 2019. To the right, I've got a little chart, and it shows us the building size and square feet of what's underway. Notice how less than 14% is for properties smaller than 50,000 square feet. This is important because on a given year, 85% of industrial leases signed are within this range. And yet developers have been building really large speculative properties, really, really large ones. Another way to kind of look at it, breaking it down further, this looks at annual inventory growth over the last 5 years by property size. So notice how little properties less than 10,000, 10,000 to 25,000, anything really below, frankly, below 99, below 100,000 square feet has barely grown over the last 5 years, whereas those larger properties, like we talked about, have really exploded, especially the 500,000 square feet category. The inventory size has increased by 60% over the last 5 years. So remember how I mentioned our absorption levels remain really strong in Houston? That's because the pace of our 100,000 square foot leases hasn't really slowed down. It's stayed steady Eddie over the last several years. What's slowing down is leases for space in this cohort, the 500,000 square foot segment. We have a lot of vacant properties now sitting on the market and a lot longer than a few years ago. Right now, it takes about 16 months for a space of this size to lease compared to 2 months in 2023. A lot of that space was built for, think, Amazon's, Walmart's of the world, who have really pulled back significantly on leases of this size. And then I wanted to just kind of highlight briefly how differently properties by size perform in terms of vacancies. So the properties 50,000 square feet or smaller, that blue line, vacancies are at 5%. They're pretty in line actually with historical trends. And meanwhile, those properties that are larger, 100,000 square feet or more, they're in that 8% range. And then I didn't include this in the chart, but properties 500,000 square feet or larger have vacancies now at 11%. Those that are those that are existing, right? So we've still got some underway that haven't been built yet without a tenant. One thing I did want to kind of mention is, if you notice these smaller properties, that blue line, we have seen rates tick up over the last 18 months. Many of these tenants are digesting major rent increases, and they're really just reducing underutilized space as a cost-cutting strategy. Some are just closing shop altogether. Interest rates have been high for a while now, and that's kept home sales low, which has really been challenging for small businesses tied to construction contractors that occupy many of these small bay spaces. So that kind of explains why we're seeing vacancies kind of tick up in that segment. So wrapping it up, if we look at rent growth right now is at about 1.6%. It's near 2016 year lows coming out of the oil bust. And this is largely due to the recent supply wave. But even so, many tenants will face notable rent hikes upon lease expirations. There's been pretty strong rent increases in recent years. So rents have grown by about 10% over the past 3 years, and by more than 33% over the last 10 years. So, like we talked about, a sharp pullback in new supply, strong, healthy, ongoing demand should really help rent growth to start rebounding in the months ahead. But it might not return to that pre-pandemic average of 2.9%, that spotted red line, until the middle of next year. Middle of 2027. All right, let's talk about retail markets before we finish off with capital markets. 3 takeaways I want you to try and remember. 1, move-outs hit their highest pace last year since 2018, and they have remained elevated so far this year. 2018 was the year of the retail apocalypse in the US. 2, well-located, high-quality space remains scarce. So this is a theme that I'm seeing. It's not just in office, it's also happening in retail. 3, like we talked about, groundbreakings are at record lows. So we've seen a sharp pullback in construction starts in every single property sector. So let's start off with an important demand driver, wage growth. While this has slowed, so has inflation. So the blue bar is inflation, the red bar is wage growth. Headline CPI in Houston is now trending near its 20-year average, which is about 1 to 2%. It's about 2%. Wage growth is now around 2%, which is far below the 8% levels we saw in 2023, but it's still outpacing inflation. So people still have money to spend. Now let's talk about move-outs. So store closures, they have been rising for a while now. They rose to their highest level since 2018. This is not a specific trend to Houston. It's really a national one. And due to several factors. So rapidly rising costs, a challenging capital markets environment, significant competition from value and e-commerce retailers. It's forced certain retailers like Walgreens and Family Dollar to close underperforming stores. Also worth noting, coming out of the pandemic, we saw a flurry of retailers opening, seeing that so many people were flushed with cash with those stimulus checks. So there is, in my opinion, kind of an extent of a right sizing, if you will, going on in terms of store closures. It's not that the sky is falling by any means. We just saw a lot of, like I said, a lot of retailers open up coming out of the pandemic, and now there's a bit of right sizing, I think, going on in Houston specifically. So we've got move-outs edging higher, new supply has also been higher over the last 2 years. A lot of it has been small strip centers built without a tenant in place in fast-growing suburbs that have historically leased very, very quickly. Developers have definitely followed rooftop growth, and so many have been building these smaller centers on spec. We've seen a lot of retail pop up in far south. So like I mentioned, that's where Manville, Alvin is, below Pearland. It's an area that's seeing a lot of population growth. Far Katy South, far southwest, Bridgeland, all of these fast growing suburbs, retail follows rooftops very much. And so we have move outs edging higher, we have supply edging higher, and that in turn is pushing availability higher. So in Houston right now, overall retail availability is at a 3-year high. For context, in nationally, it's near record lows. However, if we break it down by segments, it definitely varies, this tightness. So when I speak to local brokers, I consistently hear the market is the tightest it's been in decades, especially when looking for quality, well-located space. So for example, the Galleria Uptown submarket, the availability rate is at 2% right now. That's near historic lows. And then we're kind of seeing this trend as well, not as pronounced as in the office market, but it's also going on. So 60% of available space for retail was built before 2000. So that is significantly limiting retailers' options for new space. And then also properties 5,000 square feet or smaller. Availability is at 3.3%. It's even smaller for single tenant. So it really just depends on how you slice the data, because there are definitely certain segments where it's very difficult to find a retail space. Now, if we look at leasing activity in Houston's retail market is very much on par with recent years. We've been at or above that 2.2 million square foot mark, which is the pre-pandemic average over the last 3 years. It's a pretty active market. Now, wrapping things up for retail, CoStar, the house view has the vacancy rate anticipated to hold steady in that 5% range, which is actually right in line with our 10-year average. So the market really is balanced. It's healthy by historic standards. I added our moderate downside forecast. So if we were to get a recession, that red dotted line, and even so, the vacancy is not anticipated to really spike, if you notice. Just edge a little bit higher, but still remain well below 6%. This is because we are really anticipating ongoing healthy retail demand. So what could go wrong with our forecast? I always like to ask myself this question. Well, I think inflation ticking back up higher would mean more store closures, less consumer spending, and less overall demand. And then final, two more slides for retail. So retail rent growth, right now, it's at 5-year lows. Tenants are pushing back as rising costs are eating away at their profit margins, and they really just are struggling to keep up with strong rent bumps. Even so, when I speak to local brokers, a lot of them tell me that for quality space in highly sought after locations, a lot of landlords keep pushing those 3% annual escalations. So looking forward, this is another common theme that you've heard throughout this presentation. We are anticipating rent growth to start picking up in the next few months, aided by a pullback in new supply. Groundbreakings are at record lows in this sector. That said, it could be several quarters until retail rent growth returns to its pre-pandemic average, about 2.8%. But like I mentioned earlier, for industrial, we've seen this, and then we've also seen this for Houston. I wanted to note that as leases expire in many properties, landlords could be able to really push rent significantly. Over the last 5 years, which is the typical length of a new retail lease, rents have increased by more than 16% in Houston. Over the last decade, rents have grown by 31%. So the blue bar is Houston, the red bar is the US. For the most part, the US has slightly outpaced Houston. This is largely due to, again, our lax zoning laws. For the most part, we've been a pretty supply heavy market, and that has, that's cost rent growth performance. Okay, so last few slides, I'm going to talk really briefly about capital markets. So, couple of takeaways I want you to try to remember. Sales volume is climbing out of bottoming process. It looks like the worst is behind us. Lending is less tight, and we could continue to see easing this year. Multifamily and industrial have seen the biggest jump in transaction activity. So in this chart, you want to see basically both of these lines go up. So blue leads yellow. The blue line comes from the senior loan officer survey. Basically, is it harder or easier for people to get loans? That's basically what they're asking. The percent of loan officers tightening versus easing standards. Most CRE is finance. So if you can't get a loan, you can't buy. If lenders are maintaining standards or easing, it's easier to access capital. As transaction volume picks up, you get existing loan payoffs, and then that gets redeployed into new loans, which fuels more transactions. This fuels more payoffs, which fuels more transactions, and so on. So for the most part, we've been seeing the blue and the yellow lines edge higher, especially since the middle of last year. I'm not too concerned about this recent blip in the transaction volume heading into this first quarter. It's just one quarter, and it actually is kind of typical for the first quarter of the year. But for the most part, I'm thinking both of these lines are going to continue going up throughout the year. So like national trends, it looks like the worst is behind us in terms of transaction activity. The multifamily office, retail, and industrial properties combined totaled roughly $3 billion in investment volume last year. That was about 52% above the 2023 year figure. For context, between 2015 and 2019, annual volume averaged $7.5 billion. So we are still well below recent historic trends, but I don't think that's the story. The story is capital markets appears to be finally thawing. So by property type, we saw multifamily and industrial. They were the ones to post the biggest increases in activity. So both sectors are seeing above normal demand and a massive pullback in new supply. So you can now start underwriting stronger rent growth, and all of these factors are probably a big reason behind the uptick. If we talk about cap rates, it looks like the days of expansion are finally nearing the end. Across property types, they obviously remain very high compared to a few years ago, but for the most part, it looks like they've stopped expanding, and in some cases are even edging down a little bit. And then this is, I think, the very last slide. Moving forward, so I looked, and it looks like we've got $5 billion in CMBS loans maturing through next year. So this definitely presents a consideration for the market, if you will, as some owners of these properties might not be able to refinance. In today's high interest rate environment, this could prompt some to bring assets to market. The bulk of these, as you can see, are in multifamily and office. But one thing I do want to point out is for multifamily, CMBS loans actually just make up about 3 to 4% of all of the loans. A lot of the loans are actually through banks and life insurance companies. So while these figures are definitely worth our attention, please do keep in mind that it does usually make up a pretty small piece of the pie, especially in multifamily. And with that, that is all I have.
All right. All right. Thank you. Thank you, Tia. Very exceptional presentation. Really, the content has no waste. Really very useful for a business owner, a developer, an investor, or any professional that wants to have a more granular view of the state of the economy in Houston. Really exceptional. So I think we have time for 2 or 3 questions. One that we have is that we experience as brokers is it has been a little bit of an impact on from tariffs in leasing decisions from occupiers and tenant prospects. So specifically, can you elaborate what you see, what trends you see, or what you forecast as a consequence of tariff policies, specifically on leasing rates, occupancy, transaction volume, or on the debt markets? What are you seeing in the data, if anything?
Right. So I kind of jotted down some thoughts as I was thinking about this. So the impacts of tariffs, they're obviously going to be different by sector, but one thing I think that will be common across all is they're going to raise construction costs.
Right.
So most construction materials come from China, Canada, and Mexico. So for office, this could limit new construction and renovation of existing buildings. Like we talked about earlier, Houston does not have a lot of quality, nice new buildings. We've got a lot of old buildings that need to be renovated or demolished. I forget if I mentioned this, but half of our office stock, was built in the 1970s and 1980s. So we've got a lot of old buildings. What does this mean for leasing activity? Well, I think that we could see a slowdown in leasing activity. People just or we could see more renewals, people staying put where they are. If we see this this ongoing slowdown in construction, and we see now maybe owners decide, nope, I'm not going to renovate. The tariffs are through the roof. Constructions, I don't have the money. So that definitely could impact the leasing market. For retail, tariffs will mean rising costs. This will mean choppier sales, and this could very well mean more store closures. Also, service-based tenants will likely see weaker demand, higher operational costs. So all of this could, again, impact less leasing activity. For industrial, well, tariffs typically lead to a decline in trade. So logistics space could be vacated by distribution companies and retailers if trade and sales fall. And then in terms of capital markets does not like uncertainty. That's the one thing it doesn't like. You can eventually figure it out in terms of underwriting. If the 10-year is high, but if it's stable, you end up finding a way. But if it's uncertain, what I predict is perhaps this slowly thawing that we've seen in the last 6 months might stop, and we might again start to see investors go back to the sidelines and wait for the storm to pass.
All right, thank you for that. Danny, do you have any questions you want to add?
Yes, I do have one from a business owner perspective. What can we expect for rental rates in the next lease or renewal for the 25-26, specifically for industrial, retail, and office?
So that's going to very much depend on size, location, and quality. So let's break it down. Industrial, the small bay properties are seeing the strongest rent growth. So think 50,000 square feet and lower, but especially 25,000 square feet and lower. We've been seeing some pretty strong rental rates. It really depends on the property, but I was seeing about 4-6% last year. For the larger properties, it's obviously harder to push rates right now, just because that's where the supply wave has been concentrated, and you're seeing a lot more concessions, several months of free rent. I'm not really seeing this in the small bay properties for the most part. In terms of office, there's a huge difference of performance by quality and by size. So by size, again, 20,000 square feet or smaller office buildings tend to see much tighter vacancies, and those are probably going to be able to push rental rates more. Those large buildings, 50,000 square feet or higher, especially those struggling with occupancy, are going to have a really hard time pushing rates. And then there are exceptions. So in city center, there have been certain buildings that I've been told have been able to push rents in the double digits over the last 18 months, which is exceptional. It's definitely bucking the metro trend, and it's because you're able to push rents if you've got a shiny new building in the right location. By right location, I mean walkable amenities, nearby restaurants, gyms, anything where the employee can do a lot of things at once is walkable. There's parks. So certain areas like that, you're able to push rents. But older buildings, especially with high occupancies, I think they're still gonna keep struggling. And then in terms of retail, you know, I've seen landlords still push 3%, 3.5% in areas where supply is drying up, and there's still strong demand in certain suburban areas. It's really a supply demand story is what it comes down to.
Okay.
Thank you.
Thank you. It's here. So I think we have time for one more question, and we need to touch on cap rates, the cap rate trends, where we are and where we're heading. I think you touched a little bit on your presentation, but maybe you can comment here. So given that we're in historically high interest rate environment, and from your presentation, we see that we have increasing loan maturities, CMBS loans specifically, expiring 25 and 2029. What trend do you expect on cap rates for the next 12 to 40 to 24 months?
So CoStar is the house view at CoStar. We're anticipating cap rates to either stay where they are, or start to slowly fall. Obviously, you know, the 10-year is going to dictate a lot of that. Like you said, just general interest rate situation. I've seen cap rates expand a lot more in large underperforming office buildings versus, for example, medical office buildings. Medical office buildings cap rates are maybe 100 basis points above what they were from their 2022 lows, maybe 100 basis points. Meanwhile, for these large underperforming office buildings, they've expanded by 200 basis points, sometimes more. So it really does depend. Something that I have noticed though is that the single tenant retail segment has seen cap rates tick higher lately. I'm kind of watching that trend because nationally it looks like it's finally stopped, but they were ticking higher. They're still low compared to other parts of retail, but they have been ticking a little bit higher as well. But to answer your question, you know, CoStar is predicting, despite all of this uncertainty, that the peak of the expansion rate is behind us for cap rates.
Okay. Do you see any evidence of distress sales in the
Very
data
much.
as a consequence of the loan maturities?
Yeah, very much, very much. So multifamily is definitely not the bloodbath people thought it was gonna be. Um, there were obviously a lot of multifamily sales done in 2021 and 2022, 2020, yeah, 2022, when floating rates were really low. But for the most part, it wasn't that many at a larger scale. So I have not seen that many distressed sales at all in multifamily. Sometimes, sure, some rare, but not that many. In office, I'm seeing
Yeah.
more and more and more distressed sales, and I think we're gonna see a lot more throughout the year.
What about industrial and retail? We don't see any in industrial
No,
retail.
no, I
What
haven't
about
really seen a lot, no.
Okay. All right. I think we're exhausted the time. Thank you very much, Itzia. It's always a pleasure to share time with you and your CoStar team.
Thank you for having me.
Thank you very much. Just a special thank you to again to our remarkable speaker, to the audience, to the sponsors, and finally a thank you to the team in the Chamber of Commerce that makes these seminars possible. So with that, thank you everyone, and this concludes our presentation.
Thank you, Rod.
Thank you.